Welcome back to the deep dive. Okay, so you sent us a big one. This time, Simon Dixon's latest Bitcoin Hard Talk, episode 98, part 2. It's nearly an hour long, titled Fiscal Dominance, AI and Crashing Europe with Energy.
Yeah, a real marathon. And we know you probably don't have that full hour to spare.
Exactly. So consider this your essential TLDR, your intelligence briefing on it.
Right. Our mission today is pretty straightforward. Distill Dixon's analysis. He connects global finance, energy geopolitics, and U.S. policy mechanics. We want to make sure you get the core ideas fast.
And the central argument really is provocative. Dixon says we're deep in a fiscal dominant cycle.
Fiscal dominance, yeah.
Which, basically means monetary policy, that what the Fed does, it's not in the driver's seat anymore. It's all about managing government debt and, well, pumping assets.
It's serving the debt machine, essentially.
Yeah.
And we need to unpack what that actually looks like in practice.
Okay, so let's start where Dixon does, with the Federal Reserve. That recent rate cut 25 basis points. Dixon argues this was totally predictable, but not for the usual reasons.
Not at all. He sees it as driven entirely by this debt situation.
But wait, inflation is still above the Fed's target, right? So cutting rates seems backwards.
It does, if you're looking at it through the old lens. But this is fiscal dominance in action, according to Dixon. The main goal isn't fighting inflation anymore.
It's about making it cheaper for the government to spend and roll over its debt.
Precisely. They need lower rates to refinance everything without debt payments just exploding.
Yeah.
Dixon actually compares it to strategies you see in distressed emerging markets.
Oof. Applying that label to the U.S. system, that's a statement.
It really is, and it's core to his analysis. So if inflation doesn't justify the cut, the Fed has to lean on the other part of its mandate, unemployment.
Which, as Dixon points out, apparently required some, let's say, interesting data adjustments.
Yeah, interesting is one word. Dixon claims there was a massive manipulation. He points to what he calls the largest negative revision of jobs data in history.
Seriously, how big?
He alleges nearly 1 million jobs were overreported between March 2024 and March 2025. Then, boom, a sudden downward revision.
Just in time for the rate cut.
Exactly. This sort of magic jump in the unemployment numbers gave them the cover they needed, according to his analysis.
So, tweak the data, justify the policy, keep the asset pumps going, which leads to
a K-shaped economy accelerating. Dixon points out that when the dollar weakens and we saw the DXY dip below 97, again, assets are where the money flows.
Stocks, real estate, gold hitting, over 3,700 at all-time highs.
Right. But he argues it's not because these things are suddenly worth that much more intrinsically. It's the denominator, the dollar, getting weaker.
So it's a deliberate decoupling. The real economy might be struggling, but asset prices soar. Good if you own assets.
Great if you own assets. Not so good if you rely on a paycheck. It concentrates wealth. That's the mechanism Dixon describes.
Okay, so if U.S. policy is weakening the dollar and driving up debt, how are other countries reacting? This brings us to Dixon's points on global creditors.
Yeah, who's holding all this U.S. debt? Let's look at the biggest holder, Japan. They've got about $1.2 trillion in U.S. treasuries.
A huge amount, and Dixon sees them making moves.
He does. He says Japan's hiking its own rates, starting to sell off U.S. assets, and refocusing more regionally. And crucially, Japan can do this.
How so? Their debt to GDP is massive, even higher than the U.S.
It is, like 230%. But unlike the U.S., which Dixon says just prints more debt, Japan has enormous asset surpluses backing that up. They have financial strength the U.S. lacks, in his view.
So they're unwinding their U.S. position. What does Dixon call this? Some kind of reversal?
He calls it reverse dollar milkshake theory in reversal mode.
Okay, break that down.
Well, the dollar milkshake theory was basically that global capital will get sucked into the U.S. dollar and treasuries. Japan, Dixon says, is doing the opposite, selling U.S. debt, buying their own currency, the yen, and lending to their own government, pulling capital out of the U.S. system.
And if Japan keeps selling and maybe others join in?
Then U.S. long-term borrowing costs could become unaffordable, which, Dixon argues, just forces the U.S. deeper into that short-term fiscal dominant cycle, needing low rates to manage the immediate debt rollover.
Okay, so Japan's pivoting. What about the U.K., the second largest creditor? Dixon's take is pretty stark there, right? He uses the term vassalization.
Yeah, quite harsh. He essentially argues the UK is being treated like a bankrupt piggy bank for the U.S.
How does that work?
Dixon claims they're being pressured to fund Ukraine weapons purchases, benefiting the U.S. military-industrial complex, while also being forced to lend to the U.S. government to prop up the dollar, all despite the UK's own serious financial instability.
And we see signs of that instability in their bond market, the gilts.
Exactly. Those spiking yields on UK long-term bonds, the gilts, signal major distress. Dixon even connects the timing of high-level U.S. administration visits to the UK with ensuring London keeps lending, no matter the cost domestically. Geopolitical pressure, maintaining the U.S. debt structure.
Which neatly leads us to the next piece, Europe. And there's an interesting link Dixon makes with AI first.
Yeah, the AI paradox. He notes it's one of the few things actually pushing down inflation structurally.
But it also potentially increases unemployment, right? Through
Right.
automation.
Exactly. And that increased unemployment then becomes the justification the Fed uses under its mandate to keep the asset pumps going via fiscal dominance.
Wow. So a disinflationary force gets twisted into a reason for more inflationary policy.
That's the paradox he highlights. But the more direct strategy targeting Europe, Dixon claims, involves energy. He talks about a U.S. proof of weapons network actively working to crash European economies using energy policy.
He frames it as economic warfare, using sanctions as a tool.
Pretty much. He argues the official line sanctioning Russian energy to hurt their war effort is misleading. Russia just pivoted sales to BRICS nations. The real target of the sanctions, Dixon contends, isn't Russia. It's Europe itself, sanctions on Brussels.
Why sanction your own allies? What's the end game there?
Structural dependency. Forcing Europe away from cheaper Russian energy and making them reliant on expensive U.S. liquid natural gas, LNG. Think companies like Chevron, Exxon.
So it's about shifting energy markets and control.
And weakening European competitors. Dixon points to a specific EU-US trade deal locking Europe into buying, I think it was $750 billion worth of U.S. energy by 2028. He argues this forces Europe to deindustrialize, become more as a service economy.
That ultimately supports the U.S. debt system and leads to that awful choice Dixon mentions for Europeans, eating or heating.
A brutal consequence, yeah. This picture of controlled decline sets up his final points about asset stripping.
Okay, so where does Dixon see this heading? The final asset stripping moments, he calls them.
He sees current policies basically consolidating the system, moving towards full vassalization, even domestically.
Yeah.
And he focuses heavily on U.S. real estate as the next big target for financialization.
Right. He mentioned Fannie Mae and Freddie Mac potentially merging. Weren't they central to the 2008 crisis?
They were deeply involved, backing many toxic assets. Dixon sees a potential merger now as a way to restructure, privatize the gains from housing, and massively expand into basically mortgage trading.
Creating new complex financial products.
Exactly. New financial weapons of mass destruction, as they were called back then. MBS, mortgage-backed securities, CDS, credit default swaps, maybe even tokenizing real estate debt on blockchains.
So taking the entire U.S. housing market and turning it into tradable complex derivatives, potentially setting up another huge risk.
That's the danger Dixon outlines, subjecting housing to the full force of the financial industrial complex.
Right.
And he connects this financial elite directly to the tech elite.
That White House meeting he flagged just before the UK trip with all the big tech CEOs, Microsoft, Google, Apple, Palantir.
Us. Dixon sees these figures representing, trillions in market cap and commitments as key nodes influencing U.S. policy, buying access for the technical industrial complex, as he puts it.
So finance and tech converging to drive this agenda.
That's the picture he paints. And the final piece, almost symbolic for Dixon, is the rebranding he mentions. The Department of Defense apparently becoming the Department of War.
The mask-off moment.
He sees it that way.
Yep.
A sign that the financial military industrial complex feels secure enough to be overt. It normalizes conflict, which justifies the money printing needed to fund it, which fuels the whole fiscal dominance cycle.
Okay, so let's pull this all together for you listening. Dixon's analysis suggests these huge global events aren't random. They're connected by this strategy of fiscal dominance using debt, energy politics, data manipulation, all to keep asset prices inflated and concentrate wealth, whatever the cost, to the real economy or even allies.
And looking forward, Dixon's final thought is pretty stark. If America's main export is just debt, he argues the system is inevitably moving towards a much more controlled, centralized technocracy. Think integration. Social credit scores, maybe carbon credit tokens, central bank digital currencies or stablecoins, all potentially woven together. An Orwellian system perhaps built on this foundation of fiscal dominance, monitoring, and controlling finance. That, Dixon suggests, is the landscape you need to be watching very closely.
A really sobering outlook connecting finance, tech, and geopolitics. Definitely encourages you to dig deeper into fiscal dominance and keep an eye on those treasury sales. That's all we have time for in this deep dive.
We'll talk to you next time.